This show is produced by the Hartman Media Company. For more information and links to all our great podcasts, visit hartmanmedia.com.
5 out of 5 for the Jason Hartman podcast. It's been one of the best alliances I've ever made. Thanks to his teachings, I have no worries about my future. My future is bright, and that for my family. And like he always says, it's an amazing time to be alive. The way he explains things, inflation and inflation-induced debt destruction, just amazing.
Welcome to the Creating Wealth Show with Jason Hartman. You're about to learn a new slant on investing, some exciting techniques, and fresh new approaches to the world's most historically proven asset class that will enable you to create more wealth and freedom than you ever thought possible. Jason is a genuine self-made multimillionaire who's actually been there and done it. He's a successful investor, lender, developer, and entrepreneur who's owned properties in 11 states, had hundreds of tenants, and been involved in thousands of real estate transactions. This program will help you follow in Jason's footsteps on the road to your financial independence day. You really can do it. And now, here's your host, Jason Hartman, with the complete solution for real estate investors.
Welcome to episode 1738, and greetings from beautiful Orlando, Florida. We just finished up our Empowered Investor Live conference here last night. Well, actually, should I say this morning, because a lot of people were out partying the wee hours of the morning. If you like to have fun, be sure to join us for our next conference, because they are a lot of fun. Mostly for everyone except me, because I'm working I'm working hard. And as you can tell, I lost my voice, but it was worth it. It was really a great time, and everybody had such positive feedback and said they really enjoyed themselves. So thank you for all of you who came out and joined us for the conference. I know many of you planned side trips and you're touring around Florida, and just wanted to say it was so great seeing everybody. Our first live event in almost 2 years. I tell you, live events are just a lot of work, a lot more complicated than having a Zoom event online, but it really is worth it. It really is just so great to see everybody and to give them a fist bump. Yeah, the handshake is going out of style. It really is. But again, thanks to everybody who came out. I know you learned a lot. Thanks to all of our speakers, our local market specialists, just everybody. It was a great time. George Gammon was out. Bob was here talking about asset protection. George was talking about protecting one's freedom and finances at the same time. It was just such an awesome weekend. So thank you so much to everybody. Also to our team. You know, I'm so proud of our team. They just care so much about our clients and really put their interest ahead of everything else. And it's just great to be working with such great people. So just a wonderful time. So happy to report that. And today we have got one of my many interviews. You know, sometimes I find that my best teaching, and I've heard this feedback from you, but I actually do agree with it. Sometimes my best teaching is when I'm being interviewed by somebody else. So we'll have one of those interviews for you today. And I guess without further ado, since I have almost no voice yet, we'll just go ahead and get right to that interview. So here we go.
We're asking the question and answering the question with some data as to whether the real estate market is in a bubble. Without any further ado, here we go with Jason Hartman. Jason, thank you for joining us today.
Hey, it is my pleasure. Great to be here, Taylor. And I'm looking forward to talking about the market and answering the question on everybody's mind. Are we in a bubble? Just want to say one thing, because people kind of throw that passive word around a lot.
Sure.
And, you know, we hear it a lot too, so it's no big deal. But I don't really think there's any such thing as a passive investment. Even literally a bank account is not passive. You need to be aware of taxation, inflation. Certainly investing in stocks, bonds, mutual funds are not passive. I think that is a myth. You better know what you're doing. You better keep track of what's going on in the marketplace. So I don't really think there's anything passive, but there are degrees of it, right? It's a spectrum, right? Of more or less passive, for sure. No question about it. If you're flipping houses, that is most definitely not passive. And if you're investing in a fund, that is more passive. But again, everything requires attention. Okay. Yeah.
Yeah, absolutely. It's a great point. I've heard others say they prefer the term residual, quote unquote, which I think is a little more accurate, but also not quite as sexy as far as the name of a show goes or the goal in our investment.
Fair enough.
Point well taken, though.
I agree. Just wanted to point out that little distinction. So, one of the challenges I think people have, and is we as humans, we need to understand what we are measuring things against. So, for example, every decision we make as people, whether it be about our money, about our investments, about who we're going to date or marry, is a decision based on comparison. And since you listen to my show, Taylor, you know that common question I'm always asking my listeners, and they've actually dubbed it the Jason Hartman question, although I obviously did not invent the question, but I sure do say it a lot. The question is, compared to what? Right? That is the question, compared to what? So when we're evaluating real estate values, most people, in fact, almost all people, are only comparing to one thing, dollars. And that is a huge mistake. And I think people that do that are asking for trouble, because dollars are just a symbol, right? They're somewhat meaningless, actually, in a lot of ways. We've all heard the term fiat currency by now. It means by authority or by decree. It has no actual value unless the people in power say it does, right? And so if you're only comparing the price of real estate in dollars, that could be a very dangerous mistake. So what I want to do today is compare real estate to many other things, because I think they can make much more accurate assessments and much more accurate decisions of valuation. Are we in a bubble? Are we not in a bubble? Well, I'm going to try and answer that question, but teach people how to come to the conclusion themselves rather than just saying, yes, we are, or no, we aren't, right? And it's all about the measuring stick. It's all about asking the question, compared to what? Now, one of the things I do want to say is that when we talk about real estate prices, we need to understand that there are really three types of markets in the United States and around the world. There are linear markets that are slow and steady, and I believe very profitable. They produce great yield, great cash flow, and slow and steady appreciation. There are cyclical markets, on the other hand, that get all the attention. They're the ones in the news. They're the ones everybody's talking about because they're newsworthy. They have glorious highs and really ugly lows. They're places like where I grew up, Los Angeles. They're the sort of the trophy cities around the country and around the world. New York, LA, San Francisco, San Diego, Seattle, Boston, Miami, Palm Beach, where I live, right? These kind of places are cyclical markets. Around the world, there are places like Paris, London, Dubai, Hong Kong, etc., right? These are these sort of trophy cities. But I don't believe those cities are very good to invest in because they're kind of a roller coaster in terms of prices, and the cash flow isn't as good. And then there are hybrid markets that are in between the two. Okay, so we need to understand that first. And when we look at the index today, given our limited time, we're only going to be talking about the national median house price when we make our comparisons. And look, that's not perfect. I'll be the first to say that. However, it's very hard to slice and dice 3,100 counties around the U.S. in the short time we have. So we're just going to go with a broad view and look at the compared to what question and ask ourselves, is it cheap or is it expensive? And by doing that, we're going to maybe have some ideas to whether or not we are in a bubble. So the index I developed for this is the Hartman Comparison Index, an index that instead of comparing real estate to the price it used to be, it's going to compare it to the price, not only what it used to be, but to over 40 other things, right? And by doing this, we can really better understand the value. What do you think of that?
I love it. I love that you're, like you said, kind of stepping away from looking at it in terms of absolute dollars and the prices of housing and comparing it more to like a basket of goods. I mean, I hate to get a little conspiratorial on you, but the government kind of tries to trick us with the CPI and adjust it and kind of be a little dishonest about the rate of inflation. But you're trying to step back, zoom out, and actually be honest and really maybe build your own basket of goods against which to compare the price of real estate.
Yeah, absolutely. Absolutely. And you are too kind when you say the government is maybe being a little dishonest.
I don't want to offend anybody out there. But
They are being incredibly dishonest. Let me offend them for you. The CPI, the Consumer Price Index, the most widely used measure of inflation, is an epic scam. Okay, it is highly manipulated. 3 major ways they manipulate it: through weighting, substitution, and hedonic indexing. Weighting means in this basket of goods, they give different items different weights. Substitution basically says if the price of beef goes up, everybody will just switch to chicken. They assume that, but hey, maybe you think chicken's a dirty bird and you don't like chicken. The substitution is an assumption they make, which is not necessarily true. And then hedonic indexing is based on the root word hedonism. How much pleasure do you get out of an item? So as technology advances, items become less expensive many times, especially if they're tech-oriented like iPhones, but because they're much more powerful, so they'll assume you pay less than you're really paying because the product got twice as good. They assume you only pay half as much. And that is, it has like a logical kind of idea to it, but really it's a scam because, Taylor, what it says to us is that we as people aren't entitled to progress. The Consumer Price Index is entitled to progress, not the people. Imagine if we hedonically index the price of everything in the world or everything we buy to the invention of the wheel or the light bulb, right? Everything would be free, right? That's just nonsense. We as people are entitled to progress, right? So yeah, it's a scam. Okay, so let's compare the price of housing to gold. Now, I'm not a gold bug. I think gold is not a great investment because it doesn't produce income, it doesn't have tax benefits, and it's highly manipulated also. But it's a pretty decent measuring stick, and it's been considered money for 5,000 years. Okay, so if we look at gold, it gives us a clue. It's one thing to measure against. There's over 40 in the index, but let's talk about gold for a moment. Way back in 1970, a year before we went off the gold standard in 1971, if you wanted to buy the median price house, which priced in dollars, was $22,600, and gold was $35 an ounce, it would take you 646 ounces of gold in your suitcase to buy the median price house, right? And if you fast forward to today, June of this year, so it's not exactly today, but close enough. If you want to buy a $348,000 median price house, gold is $1,787 per ounce at the time of this calculation. It only takes 194 ounces of gold to buy the median price house. So Taylor, compared to 51 years ago, I'll just ask you, priced in dollars, houses seem expensive, right? But priced in gold, is it cheap or expensive?
If you price it in gold, right? It's a lot cheaper.
Yeah. In fact, it's less than 1/3 of what it cost 51 years ago. So housing is cheap, priced in gold, very cheap. So the dollar is a fluctuating measuring stick. And that's why it would be improper to use the dollar as your measuring stick. It's one measuring stick, but it's certainly not the only one. It would be a huge mistake to make it the only one. So priced in gold, we know that real estate is cheap today. Now, what about Bitcoin? Okay, I'm not a huge cryptocurrency fan. I own some just as a hedge. I don't want to miss out if it goes through the roof again. But, again, it doesn't produce income, doesn't produce cash flow, doesn't have good tax treatment. You can't finance it, or at least not very well. Real estate is a really special asset class. Okay. But Bitcoin wasn't invented back in 1970. So we can only go back to about 2000, right? 2010. It was really a little bit before that, but it's close enough. The median price house in 2010 was $224,000 in dollars. And back then, 0.29 cents was the price of Bitcoin, right? It was 29 cents. So back then, 11 years ago, it would cost you nearly 800,000 Bitcoin to buy a house, to buy the median price house. But in June of this year, when that house was $347,000 and Bitcoin was $34,800 an ounce, I'm rounding a little bit for speed, obviously, it would only cost 10 Bitcoin to buy a house, right? So priced in Bitcoin, is housing cheap or expensive? It's cheap, right? Okay, what about this one? Oil. The whole world runs on oil. I would argue that this is maybe the world's most important commodity, oil, right? Doesn't matter what the tree huggers say. We are not really using solar in any significant way or wind or any alternative. Oil runs the world. Just accept it. It's a fact. Oil is potentially the most important commodity to the human race at this time.
So current paradigm, absolutely.
Yeah, absolutely. So 1970, oil was $3 a barrel. Remember, I think a barrel is 55 gallons. Okay, so a barrel of oil, only $3, right? Really cheap, priced in dollars. And the median house price, remember, was just over $22,000. So back in 1970, 51 years ago, it would be 6,746 barrels of oil to buy the median house. But today, or in June of this year, the median house price is $348,000, give or take. Oil was $75 a barrel. It would only be 4,622 barrels of oil to buy the median price house. So the question is, priced in oil, is housing cheap or expensive? It's cheap, right? It's cheaper than it was 51 years ago, 2 generations ago. So far, in gold and oil, housing is cheaper, right? But it's not cheaper in everything. Actually, priced in orange juice, which is another commodity, housing is more expensive. So in 1970, if you wanted to buy the median price house, it would take you 51,000 pounds of orange juice. Today, it takes you 280,000 pounds of orange juice. So priced in orange juice, housing has become dramatically more expensive, right? But orange juice isn't that important. Now, what I might recommend people do, since orange juice is so expensive, is you can economize on your orange juice by adding champagne or vodka to it. Just a tip. Okay.
I support that.
Yeah. Rice. Rice is a commodity, Taylor, that is the basic food supply of 2/3 of the world's population. It's a hugely important food. So in 1970, if you wanted to buy a median priced house in rice, you wanted to trade rice for it, it would take you 43,000 hundredweights of rice. That's the way they measure it. Today, only 27,000. So priced in rice, housing is cheaper than it was 51 years ago, over a half a century ago, right? And I could keep going on and on. Let's do one more. Let's do shares of the S&P 500, because one of the things you asked me before is, Jason, what about the house payment? And I definitely want to get to that, time permitting. Okay, but let's just do the price of the house. Remember, so far, we're just talking about the price of the house, not the payment on the house every month, which, by the way, is the way most people buy a house, based on the monthly payment, not the price. Okay, let's go back to 1970. Median house price, $22,600. One share of the S&P, $93. 243 shares of the S&P would be required 51 years ago to buy the median price house. Today, the median price house will only cost you 80 shares of the S&P 500. So priced in shares of the S&P 500, which you could easily argue represents almost the entire economy, all right? Is housing cheap or expensive? Well, it's about 1/3 of what it was 51 years ago. Let's just look at 21 years ago. Let's go to 2000 and look at the S&P, right? So in the year 2000, the median house price was about $173,000. S&P shares were $1,455, and it would take 119 shares of the S&P to buy a house. Today, it only takes 80 shares. So over time, you can see it does fluctuate, but it's cheaper today than it has been at any time in the past 51 years when priced in the S&P 500 index, okay? So we could do this on median income. We could do it on a whole bunch of other commodities, sure. But maybe you have questions, and we do want to talk about monthly payment.
Yeah, absolutely. I'd love to get to monthly payment. And my main comment about the things that you've gone through so far is I'm glad you moved from gold and Bitcoin, which I own a little bit of both, but I'm not a gold bug at all. I'm not a crypto guy, but I own a little bit because I don't want to miss out on it.
Taylor, they're insurance, right?
Yeah.
In case, they're insurance against FOMO, fear of missing out.
Right. But ultimately, folks out there listening are going to say, well, gold, but I don't have any use for gold. Bitcoin just kind of sits there, doesn't do anything. The price of oil and other commodities, orange juice, rice, maybe mean a little bit more to us. And we're starting to talk in terms of actual utility rather than some financial instruments.
You're absolutely right. And, I'm so glad you mentioned the word utility, right? Because when we want to understand the value of anything, I believe, and this is just my own thinking on this as a hack economist, I believe there are two primary drivers of value for anything on Earth: scarcity and utility. So ask yourself, whatever you're investing in, does it have a sort of a built-in scarcity to it? And real estate sure does, because it's expensive to build. Cities and environmentalists don't want anybody to build it, right? Well, they do, but there's this tug of war.
You got to do it the right way. Everybody has to have their pound of flesh.
Yeah, of course. You got to bribe people, everything, right? Lobbyists, environmental impact studies, and, there might be some little bug on the land that you got to worry about, and, all this kind of stuff, right? So scarcity and utility, housing certainly has utility, but when we look at dollars, right, or any currency unit, it could be dollars, euro, yen, peso, whatever, right? Brazilian real, doesn't matter, right? Any currency unit, does it have scarcity and utility? Well, we certainly know the drunken sailors running the government and the Federal Reserve and other central banks and other governments around the world are printing money like it's going out of style. And so the scarcity component is really being debased dramatically. So scarcity is one thing. Now, the scarcity also sort of dictates the utility, because the more supply of the dollars there are, the less utility each dollar has, right? Because every supplier of goods and services in the economy, as all this tidal wave of newly minted dollars is coming at them, and when I say printed or minted, it's really created electronically mostly, but you get the idea. As this tidal wave of currency is coming at them, what do? They say, hey, well, I sell actual goods and services that are inherently limited. I can only produce so many widgets. I can only have so many hours in the day to provide whatever service I provide. If I'm a lawyer or a hairstylist or an accountant, right? My time is limited. I can only do so much. So all you can do in response to the onslaught of all these currency units is simply raise your prices until the demand settles down. And that's the way supply and demand works. So scarcity and utility, fundamentally important things. So very good point. Okay. You want to talk about the payments?
Please, I'd love to talk about the payments, because I agree. People buy real estate and cars and a lot of other things on the payment.
Absolutely. Absolutely. And when interest rates are literally 1/3 of what they used to be not too long ago, everybody buys on the payment. Who cares about the price of the house? Almost nobody cares about that. They look at it like a number and they're surprised, like, I can't believe this house, used to be $100,000 and now it's $300,000. So what? What is it going to cost you every month? That's the real question. That's the question that dictates almost everybody's buying decision. So let's look at that and compare it not only to dollars, but other things in the Hartman Comparison Index. Okay, so if we take the mortgage payment on the median price home and we look at dollars, now these are not inflation adjusted dollars, they're just nominal dollars, meaning the name of them, right? The name hasn't changed, a dollar is still called a dollar. Back in 1970, the median mortgage payment was $142. Today, it's $1,170. All right. But when you adjust it for inflation, and by the way, we talked about it before, Taylor, how manipulated the consumer price index is. So the numbers I'm about to share are only based on the official consumer price index. The reality is these numbers would be dramatically lower if adjusted for the real rate of inflation. Okay, so just understand that. So in 1970, because there was no inflation yet, we're talking about the same time, it was $142, the median payment. Today, that median payment adjusted for inflation is only $169 51 years later. That's amazing. And that's based on the official statistics. I would bet if you adjusted this for using a better index like what you'd find at shadowstats.com or in another index that I like called the Chapwood Index that's not all manipulated, that this payment would really be probably $40 to $60 a month. So inflation adjusted, we have to understand the payment is already extremely cheap, very, very cheap. And that's what drives this crazy housing market that we're in. We're not going to look at Bitcoin, okay? But let's look at the other commodities we talked about. Let's look at ounces of gold to not buy a house, but to make the monthly mortgage payment on a house. So in 1970, if you wanted to pay your mortgage payment and you had your store of wealth saved in gold, and you simply converted your gold to dollars and then took those dollars and sent a check to your mortgage company, it would take you 4.1 ounces of gold 51 years ago to pay your mortgage payment. Today, 51 years later, it only takes you 0.7 ounces of gold. So priced in gold, your monthly mortgage payment is less than 1/4 of what it was 51 years ago. That's absolutely incredible. That's 2 generations ago. It's amazing, right? How about oil? What about oil? So if you want to make your mortgage payment back in 1970, it would cost you 42 barrels of oil. If you had all your savings in oil, right, you would convert 42 barrels to dollars, and then you would pay your mortgage every month. And today, it would only cost 16 barrels of oil, right? Amazing. Orange juice, it got more expensive, okay? So in 1970, it would take 319 pounds of orange juice to pay your mortgage. Today, it would take 944. So priced in gold, it's much cheaper. Inflation adjusted, it's also much cheaper for real inflation adjustments. But in orange juice, it's more expensive. And I got to study the orange juice market a little more because I'm not sure what's happening there. Yeah. Now, how about if we look at the S&P 500 like we did before? But here, we're not going to buy a house with it. We're just going to make a monthly payment. In 1970, 1.5 shares of the S&P would pay your mortgage. And I won't jump right to today. I'll jump to 1980. Back then, it would take 5.3 shares of the S&P to pay your mortgage. So it got a lot more expensive in a decade. In 1990, it went down by more than half, only 2.4 shares of the S&P. In 2000, 0.7 got really cheap there. In 2010, 0.9 shares of the S&P to pay your mortgage. And today, only 0.3 shares of the S&P to make your mortgage payment. Pretty amazing, isn't it? Yeah.
Wow.
Okay. How about hours worked at the average wage? How many hours of work does the average wage earner have to put in to pay their mortgage? That's a good question. We've got all this debate about minimum wage and about how, wages really haven't gone up much in a long, long time, adjusted for inflation. Well, in 1970, you'd have to work 41 hours at the average wage to pay your mortgage. In 1980, you'd have to work 78, almost twice as many hours. And then it went down, and today you have to work 46 hours to pay your mortgage at the average wage. So priced in hours of work for the average wage earner, housing is slightly more expensive than it was in 1970. But again, it is 2 generations. So that's not much more. 41 hours versus 46 hours today, not bad. Okay. Priced in tuition, I won't go into that one because it's sort of complicated to explain. But in pretty much every metric in the index, okay, the price of housing is pretty darn cheap. We've got graphs and charts that sum this up and tables that sum it up for people, but it is pretty darn amazing, isn't it? But I do also want to say that this is probably the most accurate way to value real estate. However, there are other factors out there. There's mortgage availability, bank lending. It's not just about the actual interest rate, but it's about how willing banks are to make loans at all, right? The interest rates could be low, but if the banks are really tight and not financing things, that's another factor. So again, no index tells you everything. This doesn't either. But this tells you, I believe, more than any other widely used real estate index out there. Certainly better than Case-Shiller index, better than the HPI index published by the FHFA, which is a mouthful. I think my second favorite index to my own, to the Hartman Comparison Index, is the one published by the National Association of Realtors called the Housing Affordability Index. That would probably take second place, I think, to this one. It has a couple of flaws that it doesn't include like retirees because it's based on income, doesn't include people trading equity within a market because that's not really based on income, and doesn't include foreign buyers. For example, I spent most of my life in California. There was a ton of foreign investment from the Middle East, from China, et cetera, and earlier from Japan, not as much lately. But the Housing Affordability Index does not count that stuff, and that's a bit of a blind side and a flaw to it. But otherwise, I think it's a pretty good index.
Interesting. Well, I love it. I'm certainly a big fan of this approach, and I think it can start to illuminate how we look at the price of housing, especially, like I said, in relation to other assets or things that we might buy that have utility, which I think is really the most relevant way to look at these things. All right, Jason, I've got 3 questions I ask every guest on the show.
Okay.
First one, what is the best investment you ever made other than in your education?
Well, education is definitely a good one. So it's
That's
good
why we take that out.
Everybody would say that. And boy, I wouldn't say it'd be a college education. It's a real world education. That's the one that's the most important. But other than that, I would have to say my first real estate deal where I bought it with money I borrowed from my grandmother and paid her back a year later because I had almost no money in the deal. The return was nearly infinite. Okay. So I'd have to say that was my best deal, probably.
Nice.
Right at the beginning of when I was, 22 years old was my first house that I lived in, but I bought a rental property at age 20 before that.
Awesome. We had the best investment. Now we go to the other side of that coin, the worst investment. What is the worst investment you ever made?
Oh, gosh. I'm going to get some flack for this one. So the worst investment, I could pick 2 of them. Number 1 was a 48-foot yacht. The 2 happiest days of a boat owner's life, when they buy it and when they sell it.
Yep.
But even worse than that was a private plane. I put a deposit down on a jet. It was before the Great Recession. And during the Great Recession, the company went bankrupt and I lost a bunch of money. But hey, I got a tax write-off. What can I tell you? And, airplanes and boats, try and stay away from those things.
Fair enough. My favorite question here at the end of the show is, what is the most important lesson you've learned in business and investing?
Oh, gosh. To distill it down to one is extremely difficult. But, I would say be careful who you trust. And I hate to sound cynical, but there's just a lot of really scummy people out there, a lot of scam artists. So you really got to be careful, and be careful relying on even background checks and resumes. Look, Bernie Madoff, one of the biggest scammers ever, his resume was phenomenal. He was president of NASDAQ. It doesn't get much better than that for a Wall Street guy. And another Wall Street guy, John Corzine, who ripped a bunch of people off with MF Global, he was governor of New Jersey. I mean, how much more credibility do you get than those 2 things, right? Those are huge credibility boosters, but even those guys scammed a lot of people.
Yeah, that's true. And the Madoff case is very interesting, especially there were a lot of folks who kind of had some inside knowledge or looked into the books and they said there is no way this guy is legit, and they didn't invest with him, but the regulators didn't do anything until it all blew up.
The SEC turned a blind eye to that one guy who outed him years earlier. Yeah.
Yep, absolutely. So that's a great point. And Jason, I want to thank you for joining us today, bringing us these lessons as very excellent, much appreciated insights into some data on whether or not we're in a bubble. It's interesting to think about.
So George Gammon, Jason Hartman, and we've created a high-level mastermind group called The Collective. The goal of The Collective is for you to learn from the 3 of us, as well as, of course, the other members, on how to build and, more importantly, how to maintain your wealth. In this video, we're going to go into detail about what The Collective is and what it can do for you. Enjoy. So I'm Ken McElroy. I've been in real estate for over 30 years. Started with a 2-bedroom, 2-bath using my own money, and now I own over $1 billion worth of real estate that I bought over the years, built a big company. We have a construction company, a development company, a property management company, and of course an investment company. And typically now we syndicate and work with large, both private and public institutions for the equity and the debt. And so what I bring to the collective is how to scale, how to grow, starting with one really small property with no experience at all and growing it into an organization, which I've been able to do that basically runs almost without me. So that's what I'm going to bring to the collective. We decided to start the collective because, one, I met George Gammon, and George brings a very interesting perspective about the economy and the Fed and the way money works and Bitcoin and alternative types of investments, which quite honestly, I was super focused on real estate almost the entire time. And even I want to be a little bit more diverse. So when I talk to George and to Jason, they're always doing very, very different things on the investment side. Jason specifically is more focused on the single family housing and what's going on in that market so that we could collaborate and have different viewpoints on different things. And so that's why I thought the collective would be good, because I think everybody's kind of searching for the same kinds of answers. So the collective means to me, basically, the collective group, the whole. And I've always been a big believer of team and collaboration. So for me, it really means collaboration, of everyone kind of coming into a room and learning from each other based on their individual highs and their individual lows, and to be very, very respectful of all their independent views on things, and to be more open-minded, transparent, and authentic. So I cannot wait for the group to get together each and every quarter, because we all have very different walks of life that we're going through. And so it's very, very cool to get into one room with like-minded people. I think the right person for the collective is somebody who's into personal development, somebody who's trying to be a better individual, somebody who's trying to have that work-life balance, trying to figure out good decision-making on the investment side specifically, good decision-making on the personal side perhaps, certainly on their health and on their wealth. The members that have already signed up are people typically that have businesses that they're growing, businesses that they've started, or businesses that they've sold. So typically they're higher net worth, and they're trying to figure out what to do with their money. They're probably a little bit afraid of inflation. They're probably a little bit concerned about where to invest. And they're obviously looking at real estate as one component, somebody that's trying to do the right things both on the personal side and on the financial side. So some of the experiences that members can expect to get out of the collective are certainly the network. And I think that's always super powerful. I've been involved in groups like this before, like EO and YPO, the Entrepreneurs Organization, and YPO, which is Young Presidents Organization, which is kind of a peer-to-peer network. And that's what I envisioned, and I think people are going to certainly get that out of there. They're going to have lifelong friends for sure from this, and they're going to meet people at every single event. But also, we're going to have fun. So as an example, things like race car driving and doing all kinds of really cool things and meeting celebrities and things like that, and fashion shows are going to be part of it. So it's kind of how do we have fun and learn together, and we're going to have that at each and every event. So thanks for watching. If you guys are interested, there's a link below you can click on. It'll take you right to the website, which has a load of information on exactly what the collective is, where the next events are, and what exactly you'll be getting if you become a member. Thanks for watching.
For real estate investors, if you have 1 or 100 properties, managing them can be challenging. What you need is a solution that simplifies a complex process and gives you control while saving you money. Introducing Property Tracker, the best tool to accelerate your financial freedom. At a glance, you can evaluate, track, and manage the financial performance or your real estate. With Property Tracker, you can quickly analyze your properties and make informed decisions. You can easily track and organize all of your income and expenses along with legal documents, contracts, contacts, and your mortgages. It makes tax time a lot easier too. We simplify the management and provide you with actionable insights into the financial performance of your portfolio. Sign up for your free account at propertytracker.com today.
Thank you so much for listening. Please be sure to subscribe so that you don't miss any episodes. Be sure to check out the show's specific website and our general website, hartmanmedia.com, for appropriate disclaimers and terms of service. Remember that guest opinions are their own, and if you require specific legal or tax advice or advice in any other specialized area, please consult an appropriate professional. And we also very much appreciate you reviewing the show. Please go to iTunes or Stitcher Radio or whatever platform you're using and write a review for the show. We would very much appreciate that. And be sure to make it official and subscribe so you do not miss any episodes. We look forward to seeing you on the next episode.